Welcome back to another top-notch video, guys. This week we'll be reviewing the week of March 19th through March 23rd. Let's dig right into it. Before we get into this week, I'm sure some of you guys are concerned with the market volatility we've been having. Just a couple of notes before we start this video. I want to take a look at some charts and just kind of give you guys up to speed about some things. So the first chart we're going to be looking at is moving averages. Now, these are a number of moving averages between the time periods of 2007, the high of 2007 during the financial crisis, 55 days after that, and this is the S&P 500, so 55 days after the S&P 500 peaked. And then this is 2018 below, 55 days after our S&P 500 peaked, which was back in late January. Okay, so as you can see with the moving averages, this is a very bullish-like perspective with our fastest moving averages on top and the slowest moving averages on the bottom here. We got some indecision and indecisiveness here, and then we have pretty much a bear market. Usually when these lines get really close, that's very dangerous. And of course, as you all know, and history can tell us, basically after December of 2007, we had the 2008 financial crisis, okay? So these moving averages kind of gave you a good clue of what was going on back then. So how are we looking today in 2008, 55 days after the S&P 500 peaked? Well, if we look at our moving averages, we have nothing similar to what looked like it back in 2007. We have these tight lines. What those tight lines mean, either a big up or down move, usually in the direction that they're going. So as you know, 2008, stocks went down. Here, back in November, stocks went up, okay? How do they look today with all the market volatility, with all the noise, filtering out all the noise? As you guys can see, we have a very clear bullish picture still for a long-term perspective. Now, I'm not talking next month or the month after that. I'm talking from a long-term yearly perspective. Stocks still look very good and favorable for some of our big index funds, so like the S&P 500, which would be ETF, IVV, or your C fund, okay? Not a lot to worry about here. So just want to reassure you guys before we get into these videos, with all that noise out there, filter that out when you are looking at your stocks. Another thing to show you to look at now, this is the Nasdaq. Of course, TSP does not track the Nasdaq, but just to give you guys an idea, you have your years down here, and you have stocks within these boxes are consolidation phases, okay? So as of 2016/2017, we broke out of a very long consolidation box, okay? Here's this little blip on the radar of what's been happening recently in the last 2 months. And just look how insignificant it is compared to the gains you've gained in the last 2-3 years. The Nasdaq follows most big indexes as well. So the other charts are similar to what this chart looks like. And look how similar it is to this period down here, where we had a box in the 90s consolidate down here. And then right when we broke out of that box, we had a small blurb just right there, sort of just like this. And then as you can see from there, we had quite a decent gain from these years. So just keep that in mind moving forward. I don't know if this will be the same as it was back in the 90s, but just keep these things in mind, being 2018, moving forward, looking at a very long-term perspective in regards to stocks, okay? The only other things I really want to show you is common missteps. Okay, so when you are looking at the S&P 500 or any of your other TSP funds or ETFs, what do people mess up on? Okay, so as you can see, this is trading days from 1984 to 2000. Okay, that was a very good time in the markets, but why did people most likely not capture the most amount of gains in that time period? If you would have stayed invested in that time period, from 1984 to 2000, you would have gained a total of 822%. The reason people don't make those gains is because from A, 1984, to B, 2000, there were 3,873 trading days. Of those trading days, 1,761 were red days, with an average decline of 0.67, and of those days, 2,105 were green days, and gained an average of 0.68, okay? But if you would have missed some of your green days and red days by trying to time the markets, you would have missed out significantly of this 822 gain. All right, and then there were also 7 flat days in there. So what are the missteps that people are making that miss this gain? As you can see, it was 54 days in the green and 46 days in the red. So about 50-50, guys, of these days. It's very hard to time the markets because you have to time the markets twice. You have to time the markets once when you get out and once when you get in. And doing that is just not easy. It's been proven multiple times that it's not something that can be done easily. And that's why we use market models such as the systems we use on this channel here to help us track markets to see what is volatility to respect and what is volatility to ignore. Okay? So what are these common missteps? Some of these common missteps are watching your markets too closely. If you are watching the markets on a daily basis, that is watching the markets too closely, okay? That's why we only do one weekly video. We try to limit to once a week, all right, because watching the markets too closely leads into watching our profits and losses too closely. If you're looking at your TSP balance and you look at it every day and you start seeing that balance, you know, $4,000 or $5,000 in the negative, it starts to change your thinking. And so you don't want to be checking your account balances daily or hourly. That's why we do a weekly video. Do not focus on forecasts. On this channel, we do not forecast what the market will be. We look at probabilities of what the market will do next. Are our probabilities right all the time? No. No one can predict or forecast the market. Watching financial TV. Pretty much everybody that does financial TV forecasts or tries to tell you buy, 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 or sell, sell, sell. That's not a good strategy. Okay? Worrying about what everyone else is doing. In the office, you'll have people that will talk about what they are doing in their TSP or ETFs. Just because they do it doesn't mean you need to do it. If they jump off a bridge, you should not jump off a bridge. Okay? Do not worry about what they are doing. Focus on your plan and stick to it. Trying to avoid volatility. So for last year, we didn't have a whole lot of volatility. Markets were very easy, but that's not how markets historically have been. Historically, we do have volatility. As I showed you in that chart with consolidation in those boxes, there is a lot of volatility in those charts. So as you can see, this is a lot of volatility. This is volatility. This is volatility. This is volatility. And this is volatility, okay? It's so hard to time the markets. If you time the market here and get out, and then you don't get back in until here, you don't gain anything through that entire period. So it's just, volatility is something that is extremely hard to try and judge and predict. On this channel we try to look at volatility to ignore versus volatility to respect. So volatility to respect is 2001, 2008. Volatility to ignore is volatility of today, volatility of the last 2 years. It's all been volatility to ignore because we've had significant gains. Always being fearful of the next pullback. If you are fearful of, oh my, when is the market going to pull back next? When's it going to have its next 10% correction? Checking the news. Always being fearful of the next bear market. You will not profit. You will miss out on this 822% gain. Okay? Always being concerned about the if or could. What could happen? What if this happened? That is forecasting. You want to look at the hard facts you have in hand and move forward. Having a short-term focus and a short-term fear. Okay? You do not want to have either one of those. So that's just a couple of things moving into this video, and now we'll get into the analysis of the video. Sorry, I want to hammer on a couple things before we got into our stocks for this week. So moving on, last week for the 19th and 23rd of March, we did have a down week, okay? So let's go through our funds. As always, we have the life cycle funds, which we don't really cover. G funds, which we do use for defensive when stocks are not doing well. More on that later. I want to first talk about markets. So overall, just dropped to 255 just because we broke the supporting line. But we'll have to see, and we'll base that off our charts, always off charts. But I could either see this potentially going lower or forming a W and bouncing back. And if you sold here, you could miss out on a potential up gain of a significant amount depending on how fast this rebounds. And I'll show this in the charts. So of course this is IVV or the S&P 500 or your C fund. And this is where I get really concerned with this fund for this week. So as you can see for this week on a weekly basis, we were coming out and it looked like we had some positive energy in the stock here with our basically with our DO, our oscillator, and we were shooting for negative 1282 versus 1180, and this week we ended up going back to 1214, which is pretty rare. Usually a weekly fake out is what we like to call that. It's pretty rare, and it usually lasts, could be 1 to 3 weeks, and so we could definitely see some negative activity based off of this. If you look at our prior videos, usually when the markets start to lose energy, we have a couple down weeks after that on the weekly charts, and we can support that with our 2-day chart. So as you can see on our 2-day chart, we are starting to lose energy again. We have our blue line below our red line, so it looks like we could be losing some energy. As you can see, we are testing the lows from back in February all the way back here. So I just really don't think this is a place to have your money at this point in time. The probabilities are not looking good for these charts, for the 2-day and the weekly chart. We like to let this clear out a little bit before we allocate funds towards this towards the C fund, before we put more money towards the C fund. So if you're getting a paycheck in the next for military in the next week, or if you're an FERS employee and you're getting a paycheck, maybe it would be good to hold off and just wait a little bit. I would say maybe a week or so until these charts improve a little bit. Let's move on to our next fund. So that the S fund is the next fund, or ETF VXF. This is the Dow Jones. So let's take a look at the Dow Jones and see what that did for this week. And as you can see, we have a similar chart. We have not tested the lows yet of February. I really think that this chart here could potentially follow what the C fund's already done. I either think we're going to be testing this 108 line, or we're going to be testing probabilities suggest that we could probably see a test of this line here. We broke through this line pretty significantly on Friday, and I just want to show this chart with a few things. As you know, we ended up selling 50% of our allocation here for the middle of, well, the very beginning of March, and then we missed out on a significant upside here with 50% of our portfolio. So we don't want that same thing to happen where we were to sell some of our portfolio here and then miss out on that gain. Okay, and as you know, we took a hit for all of this with the full portfolio, but we just don't know where this will go. We don't know exactly where it will go. So I want to just, since we have our funds allocated here, I want to go into a little more detail with it. So with the VXF, okay, we had the same kind of thing happen with our weekly chart. As you can see, the DO, that there in green, the DO was at 7.21 last week, and this week we went to 7.24. Okay, so we increased by a little bit. Usually when you have an increase in negative energy here, like we did here, you see gains erode significantly, okay? And of course, we don't want to miss out on when that market comes back, but timing the market, like I mentioned in the beginning of the video, is very hard to do. You have to time it twice, once to get out and once to get in. If you miss either one of those, your gains will be hurt significantly. Looking at a 2-day perspective with this chart, we just crossed over on Friday from the blue line to the red line. It's a significant cross. Usually these can last anywhere from a couple days to a couple weeks. The last one lasted pretty much for the entire month of February, okay, when we had the cross here back in February. So just be aware of that. In order to safeguard some capital, which we'll talk about later, we might be doing some things with our allocation, so I just want to keep that in mind. So let's move back to this chart. It's really important that I really kind of see two outcomes with this chart. I'm going to label them in black. So here you see this line down here, and it hit the bottom right here, and then we went right back up here, and I could see this potentially either coming down to right about here, this line, and then continuing upward, okay, to eventually make new highs. Or I could see this doing another thing where this line comes down, back up, which we know, and then comes back down and either tests this low or continues to test this low here, where it's right at the bottom, okay, and then continue back up, okay. Based on yearly and monthly charts, I really do think we'll see new highs eventually. I don't know how long that will take. It could take a month. It could take 5 months. I'm not sure. We don't know. But probability suggests on these charts, on the long-term perspective charts, that we could see potential upside. Based on where our funds are at now and what we have allocated, we are sitting here, and I don't want to end up losing capital here in case that happens. So we're going to do an allocation shift, I think, of a 50-50, kind of like we did a couple weeks ago when we were right around this point. And we were wrong, I will admit that, and we missed out on about that much of the market. And so if we're wrong, we'll leave some of our funds there, but if we're right, we could save some money and then re-put it in back down here, potentially. So I will go through that later on, but we're looking at that W-like effect for stocks. It's very common to see that in the stock market, so we'll see with that. Moving on from our other markets, let's move into our international fund, iFund, EFA, ETF. So with our ETF, EFA, international markets, this has tested the lows and has now gone below the lows in February, and it's below its 50-day and 50-day and 20-day moving averages. So that is pretty significant, guys. Not a place to have your funds at this point until we can see these markets either bounce off this line here and go up, and I'll show it on the chart support. So with EFA on a weekly perspective, you're seeing kind of the same picture you saw with the other two indices, with our DO at negative 1089 here, 1067, so that's a positive sign here, and then 1076, so an increase of negative energy here, and of course we had the downturn here. So I really don't see putting money towards this fund at this point. It's just something we are way below our line on the weekly. The blue is way below the red, and I just don't see any upturn as of right now for this chart based off of probability. And as you can see on the 2-day chart, we had a fake out. Usually fake outs mean that the markets will last anywhere from another week to 3 weeks. On a 2-day chart, could be like a week to 3 weeks. No positive energy here, guys, and we are starting to build more negative energy again. So no real gains throughout this whole process. A lot of consolidation looking at it moving forward. Finally, let's look at our last fund, which is the F fund, or ETF AGG. This is our bonds. So with bonds, just seeing some consolidation pretty much, basically. A lot of up-down movement right around this mark here. We did get above our 20-day moving average, okay, but we're still below our 50-day moving average. Not something I am really interested in at this point. Still just not a place to have your money. I really don't think so. And just keep in mind, if you have the life cycle funds, that does have a significant portion of your funds in bonds or the F fund. So just keep that in mind. I just don't see a lot of positive things for this fund at this point. Looking at it from a chart perspective, for AGG, we do have a positive weekly chart, so that's very good to see that, but I would really like to see these lines get a little closer, or have a cross before I start investing in this fund. And from a 2-day perspective, we basically have this is a very good positive cross, and we didn't invest last week or this week because we did see a little bit of a downturn here. We went from 3 to 284 and then back up to 3. It's just consolidation, guys. I need to see a clear pattern of this with the 2-day, and I just don't have that yet. And we will get confirmation on that with probability through our weekly chart. So we're going to wait on AGG or the F fund before we start investing our money in that fund. So moving on, after everything we talked about, let's talk about allocations for this week. So as you guys already know, for the month of March, we used our 2 allocation changes. You're authorized 2 allocation changes in TSP for the month. If you have ETFs, you are authorized as many allocation changes as you want. But for us, we use both our allocation changes, and So we don't have any more for the month, and we still have 1 full week before the next month. But looking at it, guys, I think what we're going to do is we're going to do something like we did back in the beginning of March, which was right around this point here. We allocated for 50-50 change from 50% S fund, 50% G fund, just because we didn't know if this was going to test the lows here. We thought that maybe the W would have been here, and of course it wasn't. We were wrong, and so that's why we only did 50% of our allocation. We got at least some of this gain, then we ended up putting it back in right around here. Now we did take the hit here, so we were wrong all through here, but now we're looking at something of a W for possibly here. So in order to not miss out on some of these funds, we're going to do a 50-50 split, so that way hopefully for this next week we'll not miss out on this based off the probability of our charts that we've shown. We're hoping that maybe this will come back down to right around here, test the lows for February, and then we can put our money back in for 100% allocation change in the month of April, including our contribution for April, our April paycheck. So we can buy those funds real nice and low, and then watch as the market increases back and we make that nice W effect. So that's what we are planning to do. So for this week we're doing one more allocation change. The only allocation change you can do after 2 allocation changes is to the C fund. So if funds do bounce for next week and they do go up, there is nothing you will be able to do about that. So just be aware of that. You will not be able to do any more changes if you've done 2 already for this entire next week. But for us, we are going to make that 3rd allocation change, and we're going to be moving it to the G fund. This will take effect on Tuesday, so funds will be moved in on Tuesday, March 2018 for that. So we'll have a 50% allocation S fund, 50% allocation G fund, just to safeguard a little bit of our capital, because probabilities say that we could see a little bit more of a downturn in the possible future. We are not forecasting. Like I said, this is going to be our allocation for this upcoming week based off that 3rd allocation move. Like I said, you only can move it to the G fund for a 3rd allocation move, and then I won't be able to move it at all, or we won't be able to move it at all until the next month. But I think that we could have a good little we could gain something from that. And then for our contributions, I currently have them allocated towards the G fund until I see the probabilities on our charts improve a little bit for the S fund or the C fund. I'm going to end this week with a quote, and that quote is from Blair Hall, and that is, "It's not the mathematical skill that is critical to winning, but it's the discipline of being able to stick to the system." So sticking to the system, whatever your system is, sticking to it is important. Whether you're a buy and hold and you wait for markets to increase, or you look at market analysis and you think that you can do a little bit, but with the weekly charts down for this week, we are going to continue to stick to our system, and based off of the probability that we've seen in the charts, and hopefully that works out to our favor. It doesn't always work out to our favor, but we're hoping that's what it does. That's been another top-notch video, guys, and we'll see you guys next week.